Hi there, I'm Scott Burns coming to you live from Toronto for Morningstar's Investment Conference Canada. Joining me today is Hal Ratner. Hal?
Hi, I'm Hal Ratner. I'm the Global Director of Research for Morningstar Investment Management.
And I'm Morningstar's Global Director of Fund Research. Hal, we were on a panel today at the conference that was about the building blocks of portfolios, and we got a lot of great questions from the audience, had a lot of great discussions. You know, one of the things I think for the video viewers was the first question we got from the audience was about, what are the key mistakes we see people making when they're building portfolios?
I think a few things to focus in on. I think an obvious thing is to make sure that a mistake people make is they don't clearly articulate what the goal of the portfolio is to the end investor. So by doing that, what you want to make sure is that you establish a benchmark. You establish targets with respect to risk and performance against those benchmarks, and you establish a time period over which those targets should be met. It's possible that the return benchmark and the risk benchmarks, or the risk time frame, could be different than each other, but you need to make sure that you very clearly communicate to the end investor what you're trying to do, and this will go a long way to ensuring that they're comfortable with the strategy. A second thing, not entirely related, is the tendency of people to confuse sort of having a lot of different types of asset classes or funds or investments in a portfolio with true diversification. If you have a portfolio that has every single stock, let's say, in the universe, and that's all you have in the portfolio, as large as that is, and you add, let's say, every single credit in the universe, that portfolio is not actually as well diversified as, let's say, having a global ETF portfolio and a global government rate portfolio. And that's because you're taking on a huge amount of credit and equity risk in that more concentrated portfolio. So diversification is not how many names you own or how many funds you had, but it's really how diversified the performance characteristics of each of the asset classes are.
Yeah, and I added to that, in our conversation up on stage that, really, I think the next generation of portfolio building for advisors has to look at more than just what's in the investment portfolio. Think about all the things that are happening in the client's life, the number of businesses they have, how indebted they are, how economically sensitive they are, their job, the number of properties they have, something that really assesses like the full liquidity capability, the full market risk, something beyond just the stocks and bonds in the portfolio. Hal, one of the other topics that we were asked about and talked about was, the need to build portfolios from a top-down perspective these days. I think people are feeling that more and more than they ever have before. Would you agree with that?
Yeah, I agree so. I think there are a couple reasons why that makes sense. One of them is that, again, when we're talking about building it from the top down, we're talking about essentially establishing a set of asset allocation targets and making sure that those targets will deliver a return stream that's consistent with whatever the ultimate consumption goals are of that particular client. So building from the top down really kind of takes a macro point of view. It simplifies things by saying, what are the big risks that I want in the portfolio, and are those risks aligned with the drawdown goals or the consumption goals of the individual I'm investing for.
Yeah, and it's amazing how we've got decades of research that says whether you're buying stocks or bonds at the right time is way more impactful to your returns than which particular stocks or bonds you're buying.
Yeah, absolutely.
But we spend so much more time analyzing managers or picking individual securities, and really probably not enough time at that portfolio level. And I think that sentiment's changing quite a bit.
Yeah, absolutely. And I think it's clear too after 2008, if not before then, that we live in a world where macro factors are really going to drive the markets much more, where you're seeing asset classes and securities becoming more correlated with each other, and that means that they will tend to respond in the same way to these large macro factors.
Yeah. And that's a great lead into our last topic that we're going to talk about here, and that was non-correlated assets. People ask us, so what are some of the non-correlated securities out there? And if you can name a few of those, and then also some words of wisdom you have for incorporating these non-correlated securities into a portfolio.
Well, as you mentioned in the conference today, managed futures are a class of investments that have performed fairly well and that have created a fairly uncorrelated return stream over the past few years, largely because it's really driven by trading strategies as opposed to, quote, asset class performance, and that's very helpful. I think anytime you're looking to add alternative strategies or non-correlated assets, it's really important to make sure that in fact those asset classes or those investments are non-correlated. And one of the easiest ways to get that is by focusing a little bit more on trading strategies as opposed to pure asset class performance. It's one area where, let's say, if you invest, let's say, even a traditional fund, and that fund is being actively managed, the active component of that is a non-correlated return.
Right.
So it's another way of thinking about that non-correlated return as opposed to thinking about entire classes of securities.
Yeah, and I think the world is really evolving around alternatives. I think a lot of the alternative strategies out there are actually liquidity premium that you're capturing, especially if you look at private real estate and private equity and things of that type. So a lot of adding alternatives to the portfolio, I think, is as much about non-correlation, but also as much about how much can your clients bear the liquidity risk and the liquidity premium.
Right,
and
right.
for those that can, I think they can extract quite a bit of extra incremental return from others. But for those that can, again, this goes back to that whole portfolio, that's a problem. And the last thing I'd say on alternatives is always, adding non-correlated, negatively returning things to your portfolio does not actually help. So with that, I'm Scott Burns, and this is Hal Ratner. Thanks for watching. Take care.